How fraud detection and financial crime prevention actually work in the UK. When people hear the words fraud or financial crime, they often think about individual cases, a scam call, a stolen card, a suspicious transfer. What they do not usually see is the infrastructure that operates behind the scenes to detect, prevent, investigate, and report financial crime at national scale. In the UK, fraud detection and financial crime prevention are not handled by a single system or organisation. They are the result of coordinated activity across banks, payment schemes, regulators, law enforcement bodies, data providers, and shared infrastructure platforms. These systems operate continuously and are designed to manage risk rather than eliminate it entirely. This video explains how fraud detection and financial crime prevention actually work in the UK. It focuses on the infrastructure, processes, and institutions involved rather than individual scams or consumer advice. What financial crime means in practice. Financial crime is a broad category. In the UK, it includes fraud, money laundering, terrorist financing, sanctions breaches, bribery, and corruption. Each category has different legal definitions, reporting obligations, and risk profiles. Most financial crime prevention infrastructure is designed to detect patterns rather than single events. Individual transactions rarely look criminal in isolation. Risk emerges when behavior is analyzed over time and across systems. Why banks are central to detection? Banks sit at the center of the financial system. They process payments, hold customer accounts, and maintain detailed transaction records. As a result, UK law places significant responsibility on banks to detect and prevent financial crime. Banks are required to know their customers, monitor transactions, and report suspicious activity. Failure to do so can result in regulatory penalties, criminal liability, and reputational damage. This responsibility shapes how banking systems are designed and operated. Know your customer as infrastructure. Know Your Customer, or KYC, is often described as an onboarding process. In reality, it is ongoing infrastructure. At account opening, banks verify identity using documents, biometric checks, and data from credit reference agencies. This establishes a baseline understanding of who the customer is. However, KYC does not end there. Customer profiles are continuously updated as new information becomes available. Changes in address, transaction behavior, or associated parties can trigger reassessment. KYC data feeds directly into monitoring systems that assess risk over time. Transaction monitoring systems. Transaction monitoring is the core technical component of fraud detection. Banks operate large-scale systems that analyze every transaction in near real time. These systems apply rules, thresholds, and statistical models to identify unusual behavior. Examples include sudden changes in spending patterns, payments to new recipients, rapid movement of funds, or activity inconsistent with a customer's profile. Monitoring systems do not decide guilt. They generate alerts that require investigation. Rules versus models. Historically, fraud detection relied on rule-based systems. Rules might specify limits, geographies, transaction types, or frequency thresholds. While simple and explainable, rules are rigid and easy for criminals to adapt to. Modern systems combine rules with statistical and machine learning models. These models analyze large volumes of historical data to identify patterns associated with fraud. In the UK, regulators require that models be explainable and auditable. Black box decision-making is discouraged, particularly where customers may be affected. Human review and investigation. Automated systems generate alerts, but humans make decisions. Banks employ teams of analysts who review alerts, examine transaction histories, contact customers, and determine whether activity is suspicious. Investigations may result in transactions being blocked, accounts being frozen, or reports being filed with authorities. This human layer is expensive and time-consuming, but necessary to balance fraud prevention with customer access. Suspicious activity reports. When a bank suspects financial crime, it is required to submit a suspicious activity report, known as a SAR. In the UK, SARs are submitted to the National Crime Agency through a central system. These reports include details of the customer, transactions, and reasons for suspicion. SARS are not accusations. They are intelligence reports that feed into law enforcement and regulatory analysis. Banks are prohibited from informing customers that a SAR has been filed. This is known as tipping off and is a criminal offence. The scale of reporting. The volume of SARs in the UK is very large. Hundreds of thousands of reports are submitted each year by banks, financial institutions, and other regulated entities. Processing this volume requires significant infrastructure and prioritisation. The National Crime Agency analyses SRs to identify patterns, networks, and high-risk activity. Individual reports may not trigger action, but aggregated data can reveal organised crime. Fraud versus money laundering. Fraud and money laundering are related but distinct. Fraud involves deceiving someone to obtain money or assets. Money laundering involves disguising the proceeds of crime to make them appear legitimate. Fraud detection systems focus on identifying unauthorized or deceptive activity. Money laundering systems focus on tracing the movement of funds and identifying attempts to obscure their origin. UK banks operate separate but interconnected systems for these purposes. Sanctions screening. Sanctions screening is another critical component. UK financial institutions are required to comply with domestic and international sanctions regimes. This includes restrictions on dealing with certain individuals, organisations or countries. Banks screen customers, transactions and counterparties against sanctions lists maintained by UK authorities and international bodies. Screening must occur at onboarding and continuously thereafter, as sanctions lists change frequently. Payments as a risk surface. Payment systems are a primary vector for fraud. Faster payments enable near-instant transfers, which reduces the window for intervention. Card payments involve delayed settlement and chargeback mechanisms. Banks apply different controls depending on the payment type. Limits, delays, confirmation steps, and behavioral analysis are all used to manage risk. The design of payment infrastructure directly affects fraud exposure. Shared industry infrastructure. Fraud prevention is not handled in isolation. UK banks participate in shared initiatives and data sharing arrangements. These include industry databases of known fraud patterns, compromised accounts, and mule activity. Payment schemes coordinate responses to emerging threats. Banks share intelligence through formal channels and industry groups. This collaboration is essential because criminals operate across institutions. The role of regulators. Several regulators influence fraud prevention. The Financial Conduct Authority sets expectations for systems and controls. The Payment Systems Regulator influences how payment infrastructure is designed. The Information Commissioner's Office oversees data protection aspects. Regulators do not prescribe specific technologies, but they set outcomes and hold institutions accountable for failures. This creates pressure to invest in infrastructure even where direct returns are not obvious. Law enforcement and coordination. Law enforcement bodies rely on financial intelligence. The National Crime Agency coordinates financial crime intelligence at national level. Regional police forces investigate specific cases. Financial intelligence units analyze transaction data to identify networks and high-impact cases. Cooperation with banks is essential. International cooperation is also required, as financial crime often crosses borders. False positives and customer impact. Fraud detection systems inevitably generate false positives. Legitimate transactions may be blocked. Accounts may be frozen temporarily. Customers may be asked additional questions. Managing this impact is a major operational challenge. Systems must be sensitive enough to detect crime without excluding legitimate activity. This trade-off explains why fraud controls sometimes feel intrusive or inconsistent. Why systems are conservative. Fraud prevention infrastructure is conservative by necessity. Mistakes can result in financial loss, regulatory action, or harm to customers. Changes to detection systems are tested extensively before deployment. Banks balance innovation with stability. New models are introduced gradually and monitored closely. This slow pace frustrates customers but reflects the risk environment. Technology and limits. Technology improves detection, but does not eliminate crime. Criminals adapt quickly. Social engineering exploits human behavior rather than technical weaknesses. Automated systems cannot fully prevent deception. As a result, fraud prevention is an arms race rather than a solved problem. The cost of prevention. Fraud prevention is expensive. Banks invest heavily in technology, staff, and compliance. Much of this cost is not visible to customers but influences fees, processes, and service design. Society accepts these costs because unchecked financial crime undermines trust in the financial system. Why the system looks fragmented. From the outside, fraud prevention looks fragmented and inconsistent. This is because it is decentralized. Each institution manages its own risk within a shared framework. Centralization would create single points of failure and privacy concerns. Fragmentation is a design choice as much as a limitation. Closing perspective. Fraud detection and financial crime prevention in the UK are not about stopping every crime. They are about managing risk at scale. The system relies on shared infrastructure, legal obligations, data analysis, human judgment, and coordination between institutions. It operates continuously and quietly, often only noticed when it interferes with normal activity. Understanding how this infrastructure works helps explain why payments are sometimes delayed, why accounts are occasionally frozen, and why identity and monitoring systems are so strict. In the next video, we will look at how regulation, supervision, and compliance shape the behavior of financial and technology infrastructure across the UK.